Neeraj.
Welcome back to Indian Open right here on BloombergQuint. Cement players won't be too happy with the rain gods. A slow retreat only delays construction, and that in turn pushes down demand for cement. And that is perhaps reflecting in the lack of pricing power for cement players, some of which have to roll back the price hikes taken in early October. Heidelberg Cement, given these circumstances, has reported steady numbers in the second quarter. Joining us now to talk about the quarter gone by and the outlook ahead is Mr. Jamshed Naval Cooper, the MD and CEO of the company. Mr. Cooper, good having you. Thanks so much for joining in. Best wishes for a new year. Can you tell us whether this muted sales volumes that we've seen in the quarter gone by, not just from you, but from some of your peers as well, is that a thing that could stay, or can recovery kick in as early as the current quarter?
As far as the volumes are concerned, during the September quarter, you will always see a dip in the volumes, basically mainly because of the monsoon season. It's not a new phenomenon. It is a annual phenomenon which happens year after year. And this year, in fact, the demand could have been a little better had the monsoons not been so severe the way it was. Otherwise, I think that's past now, and in the coming quarters, I think the demand should pick up.
Okay. Well, are you seeing signs of that, sir, in the first month of October? And therefore, just wondering if the current quarter itself would be the quarter wherein we could see a pickup on a relative basis compared to the last year, same period?
On October has been a little soft because of Diwali and Dussehra falling, both the holidays falling in the same month. So October was not so good, but I think from November it should pick up.
You've seen an improvement in realizations which have partly offset the higher costs. Could you give us an indication of how realizations are expected to pan out for the remainder of the year?
See, the realizations for us have been good mostly because of the brand positioning and because of some premium brands what we sell. Going forward, I think there should be a possibility of price increase if the demand is good post November 10th or so, for the simple reason that sand was a big shortage. Sand availability has started now. So I think by 10th of November, some sand should be available, which was one of the bottlenecks. Small increase can come around that time, and then somewhere in the first week of January, and then it should plateau off for some time till the severe winters will be in the north. So you expect December and mid of January to be a little difficult because the vehicles are not available, fog is there. So the movement of the traffic is also restricted. So dispatches also do take a little bit of backseat then.
Okay, so that was I think the shortage of sand was also impacted demand from UP partially. So if you're saying that there is an improvement of that starting November, mid-November sometime, you could see demand also getting impacted positively?
I think now, I don't think there should be any negative aspect to this. I am expecting now the positive side to start. Demand should now start improving because there has been some funding which has come into the government projects also. The Awas Vikas projects should start now.
Okay, let's also talk about overall debottlenecking of capacity. It's been delayed, I believe, by 3 to 4 months. When does that take place? And the overall capacities that you're looking to bring on stream total?
It's nothing. Something this was planned. We were trying to expedite it, but considering the investments what we are making, I think there's 2-3 months is not going to matter much because still we are at clinkering capacity. We are at 76% utilization. So it's a long way to go for us to exhaust our demand, our capacities to run to 100%. Although on the grinding side we are running at around 90 to 94%. Last quarter it was a little low, But I think today, as I am not finding any difficulty to see that in the coming 2 quarters we will run out of volumes. So nothing in a hurry or nothing to lose out on.
Because this was, I think, a concern from most of the brokerages, where they're saying that the exhaustion of capacity remains to be a little bit of a niggle for Heidelberg. So you're saying it's not a big issue? Mr. Cooper? Mr. Cooper, can you hear me?
Chala gaya.
It's that line. We'll just try and repatch that line with Mr. Jamshed Naval Cooper. But interesting to know his views on capacity addition, simply because if we understand, there's been a lack of significant capacity addition in the central region. So how would Heidelberg play alongside that? Would they look forward to maybe make some acquisitions, or no? The answers seem to suggest, the basic answers seem to suggest that maybe, just maybe, Jamshed Naval Cooper is not too bothered about capacity and utilization levels, because they're still far away from exhaustion. I think he mentioned that it will be a couple of quarters at least before which they reach there. However, the key point is that cement companies don't necessarily plan their capacity expansions on the basis of 1 or 2 quarters. It's a slightly longer term plan. Let's wait and watch what he has in store. The stocks, select cement names we have done okay. Heidelberg has been largely, I mean, if you just pull up today's chart or the 1 month chart for Heidelberg Cement as well, you will see that in line with, I believe, some of the other cement companies, there hasn't been too much of a deviation in stock prices. So it's not that the stock prices are running away. It's just that maybe investors are waiting for some bit of numbers to come in the print and show on the bottom line or the top line, the operating numbers, before people take a call. It's not a sector that people really want to go out and invest in full steam, because it's been plagued by a number of issues. Demand has been largely soft. Most players have not been able to show any dramatic improvement in operating numbers as well, and there are a number of reasons for the same. So why go out and try and buy these stocks as if they are running away?
Yeah, and in terms of pricing, at least the last 2 months have not seen much of a change as well. It's important to see what kind, because pricing is one of the key variables for some of these cement majors. And if you can see, it's been extremely volatile. This entire year actually has been volatile in terms of price hikes and then rolling back those price hikes. But I think the last 2 months have been relatively stable at about 366 rupees. That's the price of 150 kg bag. That's not changed since September. So that is stabilizing of pricing. But you would obviously want the pricing to go up, because prior to that, at least for 2 or 3 straight months, prices have been coming off.
Yeah, they took the price hike in the month of October only to roll it back later on, and that's the real pickle. But I think we do have Mr. Naval Cooper back. Yeah,
Mr. Cooper, I just, I don't know whether you heard me, but when we started off this conversation, while you already spoke about capacity, the brokerage community had a little bit of a concern where they have spoken about exhaustion of capacity, which remains a bit of a problem for Heidelberg Cement. Do you feel that that is the case, or you are not too concerned about capacities getting exhausted anytime soon?
See, as of now, we have at least for, if the demand grows at even 5% or 7% demand growth, Heidelberg, India does not have a capacity limitation. So for coming 2 years, we have enough capacity to service our markets. Yes, going forward, 2.5 years or maybe in the 3rd year, we could have a limitation. But by that time, we should be gearing ourselves to manage improvement in our availability, which will happen by even if I do it by 2020 end or 2021 beginning of the year, that should be good enough for us to last till 23.
But you are, Mr. Cooper, going out and trying to make that bid for Emami as well. What's the rationale there? Is it that the region and the opportunity presents something which is much better than doing an organic expansion plan?
I won't be able to comment on anything on Emami as such at the moment.
Right, Mr. Cooper, comment on the freight costs as well, and how do you see that shaping up?
Pardon me?
The freight costs. We've seen a marginal increase this quarter.
Freight cost. The freight cost might marginal increase could happen because the demand was low in our home markets, and that's why we had to extend our supply chain to a little distant markets. So that is a very temporary phenomenon which will happen in the month of, you will see it in the month of October, and November back we should be back up to our home markets. So it's a very temporary phenomenon.
Okay. Mr. Cooper, one final word really. Can you leave us with some guidance about what you would do for the rest of the year, if not in actual numbers about sales and profitability, then some sense of where capacities could be or capacity utilization levels could be? What's the sense on pricing? Anything that you can share with us?
See, our strategy more is to keep improving our market positioning year after year, and we are focusing on some strategic markets where we should be. So the teams are working on that. On the cost side, we are working consistently on reducing our costs. We are managing our fuel costs well, in terms of we are in when the pet coke prices are higher, then we switch over to coal. When coal is higher, switch over to pet coke, and we can alternate between fuels very efficiently. So now that is an in-house capability what we have built. Plus we are focusing more on renewable energy and sourcing our power from various other sources which are cheaper in nature. So these are some of the things which are on our cards, which will help us become more competitive with a more better edge in the market. So these are the things which we will work for these coming now 2 quarters. That is what it is as of now.
All right, Mr. Cooper, thanks very much for joining us. Really appreciate you taking on the time and speaking to us about your quarterly updates. That's the management at Heidelberg Cement. They're addressing the Q2 numbers. But moving on from a cement maker to talk about one sector that's one of its biggest consumers, real estate. The Finance Ministry has stepped in to try and soothe frayed nerves, extending a lifeline of sorts for stressed housing finance companies. This in turn will give the housing finance companies the much needed capital to resume lending to home buyers and in turn bail out developers who of late have turned to private equity players to bail them out. Joining us now to give us a more holistic picture of the entire sector and a source of funding is Anuj Puri, Chairman and Country Head at Anrock Property Consultants. Anuj, thanks very much for taking out the time. So, weigh in on this aspect where, the government is trying its bit to make sure that there's enough and ample liquidity, to support the sector, not just from the end consumer standpoint, but also to make sure that there is this lifeline to the developers as well. What's your sense on what's the outcome of this, and do you see things changing materially?
So, very good morning, and thank you for having me on the show. Clearly, there are 2 troubles that are currently infested on the real estate. One is on the demand side, and the other one is on the liquidity side. And the government is clearly trying to address the liquidity concern. If you were to look at the liquidity, there is a part A and a part B. Part A is on the home loan disbursement. What we have seen is many of the NBFCs who are very aggressive in the last 2 or 3 years have gone very quiet in the last sort of 8 to 10 months on home loans. Also, the subvention scheme has been taken out, and clearly the NBFCs are going soft on that, and hence the home buyer is not getting access to the loan as quickly as they were getting earlier. And the part B, which is really where the bigger problem on the liquidity is, where the developers are not getting the funding from the NBFCs or the HFCs. Clearly, when you're speaking with the NBFCs and the HFCs, they're saying is because the money coming in from the banks and the mutual funds towards the real estate sector has slowed down, as a result of which the tank that they had of the money is not getting fulfilled. As a result of which the money that they used to disperse to the developers has gone down. Now that is starting to create a trouble on its own, because the developers had assumed that there would be money that will come in from the HFCs and NBFCs to complete the project. Now that money isn't coming in. On the other hand, the demand has slowed down. So clearly there is a problem that has erupted in being able to complete the projects. And this is where the government is stepping in and saying is that we want to address this issue by bringing in liquidity so that these developers do not get jammed And we don't have situations across India as what we are seeing in Noida and Greater Noida, where half completed or 3/4 completed projects are struggling because there is not enough cash to complete those projects.
Do you feel that at this point in time, for the real estate space, the challenge lies more with the developers or with the consumer and the consumption that we're seeing? Residential real estate, aside from affordable housing, which has been okay so far, has still been struggling. Commercial real estate, on the other hand, has probably been the saving grace.
Yeah, I think you summarized it so beautifully. You're absolutely right. Initially we thought that it was largely the liquidity issue that was on to the developers. Then, that culminated into HFCs slowing down on the home loan side. And clearly on the demand side, in the last 6 or 7 months, we've seen, as there is a larger impact that is being felt on the overall economy, we're starting to see the demand slow down, other than the affordable housing. I mean, that I must give it to our Honorable Prime Minister, that he had looked into this affordable housing. That scheme, if a developer is launching, a good developer, good location, right ticket price, sells like hot potatoes. I mean, there are a couple of schemes that we launched near Dussehra and Diwali, and 500-600 apartments have been sold in 8 or 9 days. That's the take up on the affordable housing of a right developer, right location, right ticket price. But other than that, in the premium luxury sector, that is where the larger pain is, and that is where we're seeing the demand continuing to remain very lackluster. On the other hand, as you rightly pointed out, commercial is doing exceptionally well. I mean, 2018 calendar year was one of the best years. I think 2019 will surpass 2018 in terms of the demand. The rentals continue to grow between 1 to 3% every quarter. We've seen the Embassy REIT do exceptionally well. We're hoping in the next 2 or 3 months there will be other REITs that will get listed. They'll perhaps be oversubscribed again, just like what had happened in the Embassy REIT, and trade at a premium. So commercial doing exceptionally well, residential affordable doing exceptionally well. It is really at the premium luxury where it has got jammed, and that's largely in cities like NCR and Mumbai.
So obviously, while that's the takeaway, and as I'm looking at some numbers as of Q3 of calendar year 19, inventories, unsold housing units across 7 cities are about 656,000 units, and out of that, 68% of the unsold inventory still lies in the affordable to the mid housing projects. It is somewhat of a divergence to what we've just been talking about.
Yeah, it is a very interesting point. There is a large unsold inventory under construction on affordable housing, and that's because the design of that inventory is completely wrong. I think what the developers got it wrong is that it is just the ticket price, and as long as I can deliver it in, say, 40-50 lakh rupees, other than Bombay, and in Bombay less than a 1.5 crore rupee, it will be fully acceptable. It is not working like that. The buyer is saying is, whilst I'm willing to pay the price and it is affordable, but I want the full facilities, I want a livable, habitable apartment. I think where you're seeing the unsold inventory is, you stretch your arms on the 2 sides and you're touching the walls of the room. I mean, the beds can't really properly fit in, the wardrobes can't fit in, there is no space to move in those rooms. And that's where the developers got it wrong, that they only went for the ticket price, not appreciating that even the person who's coming in for affordable housing has an aspiration and wants to buy a product that he or she is going to be able to live in there. Now, as these schemes are coming in with wrong design and the buyer is going and visiting those schemes, they are saying, well, we're not going to be able to live in it. It may be acceptable to us as far as the budget is concerned, but ultimately we have to live in this. You're trying to make like a railway compartment, apartments on both sides, no natural ventilation in the toilets, bathrooms, no natural lighting in the kitchen. We're not going to be able to buy those things. So it is a huge evolution that has happened from starting in 2014 to say is it's a ticket price to now saying is that whilst ticket price is important, yet what is more important is the design and the livability index of those places.
Okay, got that. Let's also, shift this conversation back towards, the funding aspect. And from Jan to September, the last 9 months, PE funding for commercial real estate has been up 43%. PE funding for residential segment has been up 40%. Retail segment has gone down a bit. But do you see this as becoming, go-to segment to fill the gap that is there in terms of funding?
Clearly, because there is a huge amount of debt pressure coming in from the NBFCs to the developers to say is pay back our debt. How they're going to be able to pay back is only by selling those commercial assets. And that's what we are seeing. The new tone over the last 6 months is many of the developers who have these crown jewels with them wanting to sell these crown jewels to the private equity, get in the cash so that they can pay back or pare down their debt of the NBFCs so that the NBFCs can retire the money that they owed to the mutual funds or the banks. So that is how the unwinding of the cycle is happening, where the developers are selling their completed office assets, income yielding, to private equity, who has a ton of money and is giving the money to the developer, who's giving it back to the NBFC, who's giving it back to the mutual fund, and unwinding that cycle. I think this trend over the next 18 months you will continue to see, and in this process you will see is that the private equity, they will continue to consolidate more and more position, and amongst the top 5 office developers, I dare say 3 or 4 will be foreign private equity funds, and there'll be probably 1 or 2 Indian developers left in the top 5 for India.
Then what happens to the market share displacement with regards to the larger developers versus the smaller ones that are slowly running out of business because for variable reasons, not getting enough funding, sitting on a huge stock of unsold inventory, which is not sold, and they had no money to pay back debt. So what happens in that scenario?
So Divina, we used to use this word larger and smaller. I think over the last couple of quarters, I have actually changed that terminology because I've seen a lot of the larger ones fall as well. And many of the smaller ones who were less leveraged, very disciplined, had the corporate governance, took care of their customers, doing exceptionally well. So I'm saying is, those who were ill-governed, had too much of debt, are the ones who are actually at this moment in time, perishing and will ultimately get consolidated. A smaller guy, a niche guy who was disciplined and made sure that they were not taking out the money or they were delivering the projects with focus on the customer, are the ones who are going to really consolidate. Now the larger or the smaller developer who's been indisciplined, if they have income generating assets, they are still getting bailed out because those assets, they're selling it to the private equity who's giving them the money and they're being able to pay back their lenders. Those who do not have income generating assets are the ones really in grief at this moment in time and will be taken to NCLT or NPAs, and that's how we're going to see the unwinding of this situation over the next few quarters.
Okay, got that. Anuj, it was great chatting with you and getting your thoughts on the show. Appreciate you taking out the time.
Thank you very much.
All right, that's the discussion on the real estate space and what's been happening thereabouts with regards to funding, unsold inventory, demand, supply, and a whole host of other things.
Yeah, the market's flattish right now. The banks are doing well, and Z Entertainment as a stock is doing very well for itself, though I must say even Bharti Infratel is up another 4% in trade. So between 2 or 3 names, there is some activity there. But it's a wrap. About time on this leg of Indian Open at least. So from Devina and me and the team that put this show together, thank you so much for watching. Stay tuned. The FNO show takes forward the action on the other side.